Tax planning involves the implementation of various strategies to minimize the amount of taxes paid. Minimizing the tax liability can provide more money for expenses, investment, or growth and can end up in huge savings. In this way, tax planning can be a source of working capital and an added value to the shareholders. To achieve the goals of profitability and liquidity, managers of corporations use the budgeting process to help plan, execute, review, and report the corporation's financing, investing and operating activities. Taxes, be it income tax, indirect tax, import-export duties, municipal tax, or tax on properties, are part of the general administrative expenses of a company and often add up to one of the largest expense items of a corporation, and like the rest of the expenses, they should be well estimated while making the master budget or else they will cause unwanted deviations to the budgeted income statement that can affect the profitability, the cash flow, and the budgeted balance sheet. Companies that manage to minimize or waive tax expenses will increase net cash flows. And by maximizing the present value of expected cash flows for the company, the value of the company increases and thus creates wealth for the shareholders. Cash flow is affected by tax payments. So taxes impact corporate valuation. While evaluating business decisions, management should take into consideration the after-tax profit as the desired rate of return, because operating decisions are generally based on risk-adjusted net present value of expected after-tax cash flows. Therefore, tax planning is a key part of the corporate financial planning process. Globalization and multinational rapid business expansion broaden the scope of tax planning considerations. While corporate financial planning is ultimately concerned with ensuring that the financial objectives of the company are met with optimally managed risk exposures resulting in shareholder value creation, the ultimate goal of tax planning is to reduce taxes, while not excessively intruding on the organization's overall operations. However, not every idea that saves taxes is a good one, especially when it increases the tax assessment risk of the corporations with the tax authorities and endangers its reputation. The major role of tax planning is to minimize the tax burden and not to evade taxes. Now let us see some practical tax planning strategies in the following podcasts.